Well, good morning, everyone. This is Frank Stichter from Strategic Health Plan Consulting, offering up this webinar from beautiful Crested Butte, Colorado. And we're going to talk today about self-funding or partial self-funding 101. And I'll use those terms synonymously. When I say self-funding, I am speaking about partial self-funding. But we're talking about a financial option that you can plan for your upcoming renewal, whether that be, well, 2/3 of the world renews January 1. So even if you're fully insured today, you can still move to this type of, or consider this type of financial option for your health insurance anytime, as long as you give your insurance company at least a 30-day notice of cancellation. But I've been, just a little of my background, I've worked for two very large and regional insurance agencies as a traditional broker. In the past, I've been in this business, dare I say, 40 years. Partial self-funding is my area of expertise. In 2015, I started my own consulting company, Strategic Health Plan Consulting. I kind of got tired of the insurance broker world and wanted to offer my clients something different. So when we get down to it, when you look at your health plan, there's really two fundamental questions that every employer asks. What are the benefits I want to offer to my employees? So that we're talking about the types of plans, whether they're an HMO, a PPO, what are my deductibles, co-pays, do I want a high deductible plan with an HSA or an HRA? It's all about plan design. What are the benefits I want to offer to my employees? And then the second question is, what's the best way to pay for them? It's that simple. Is it a fully insured plan? Is it a level funded plan? Is it a self-funded plan? What's the best way to pay for all these benefits? So a fully insured plan, all fully insured plans are subject to the state Department of Insurance, wherever they want to do business. They have to comply with all their laws and all their mandated benefits. And there's really three fundamental types of fully insured plans. It's your traditional plan that you're all accustomed to, paying a premium every single month. There's a retrospective premium, and there's a level funded type of a program. You may be familiar with that too, but these are all considered fully insured plans, and they have to comply with each state's mandated benefits and laws in any state they want to do business in. So the way they rate these, typically if your group is less than 100 lives, you're pooled with other groups. So what insurance companies have to do is they have to file their manual rates, their book rates, and then they can adjust those based upon the age, sex, demographics of your group, your particular plan design that you offer, the high deductible or traditional PPO, whatever it might be. And they can also adjust them by your industry code or whatever location you're in, because obviously some areas of the state or the country are more expensive or less expensive than others. So they can adjust those rates and then produce those for the type of program that you're offering your employees. If you're over 100 employee lives, you are either blended between manual and experience, or you're totally experience rated if you're a larger group. And by blend, what I mean by that is they use a blend, for example, 60% of their book or their manual rating, and give you predictable, or not predictable, but credible experience to your own claims experience, or what they might expect you to have. It's not always 60-40. It could be depending on the size of your group, they could give a more emphasis to your experience, or if you're smaller, more emphasis to the manual. But it's usually a blended rate, initially as well as renewal. Experience rating, we're talking about if you are large enough to be credible, meaning you're predictable. They want to use your claims experience or a portion thereof, a portion of manual perhaps, or 100% of experience rating to predict what your claims will be for the upcoming year. So they put a buffer in there called a margin, but they come up with what they expect you to be, or what you expect to incur, your members, your employees, their family members in the upcoming year. And then they add the cost of administration, that margin or buffer, and reserves. Now, reserves are required by every fully insured insurance company in every state. Reserves are monies that you pay to the insurance company that they use to pay for claims that come in their door, that come in after you have terminated. So we have this phenomenon called claims lag, whereby if somebody incurs a claim today, it's usually 60 to 90 days from now that before that claim is actually paid to the provider, to the hospital, the doctor. So a reserve is required that if you were to terminate your coverage today, that money is held by the insurance company for claims that are sent to them that were incurred prior to termination, but come in after you've terminated. It's usually called incurred but not reported, run out. But reserves, they hold, it's your money, they hold it, they earn tax-free interest on it. And there are reserves built into your premiums each and every year. So in a traditional plan, I'm probably not telling you anything you don't already know, but there's really three ways that an insurance company will adjust your premiums. Either what we call a two-tier, which is single family rates that you pay each and every month. Sometimes they'll offer a three-tier rate, which is a single two-party, which could be employee spouse, could be employee and one child, but it's a two-party rate, and then a traditional family rate. The other that is probably the most popular is a four-tier rate, whereby they will come up with an employee rate, a rate for employee spouse, a rate for employee and children, meaning no spouse, and then a traditional family. The sum of these, regardless of which tier type rating you have, the sum of which each and every month is the same. It's just how it's dispersed among the single family, spouse, whatever. So, but the premiums don't, the total, the sum each and every month is the same. So when a business pays fully insured premiums, I mean the traditional 2, 3, or 4-tier rate, you're essentially prepaying what the insurance company expects you to have, plus administration. So you're essentially giving them money up front so they in turn can pay claims when they come in the door. Now they, depending again on the size of your group, you may have claims that far exceed the sum of the annual premium or the sum of the monthly premiums. Carriers, insurance companies, seed out risk to other reinsurers. They don't, just because Obamacare has an unlimited benefits. We all have an open checkbook for all of our claims that we may have. There's no $1 million limit or $2 million limit. It's unlimited. So companies like what we refer to as BUCA, Blue Cross, United, Cigna, Aetna, they don't take all that unlimited risk. They seed that out to other global reinsurers like Lloyd's of London or Sun Life, and they pay, and that's built into your premium, but they take certain risks over a particular amount. So when you're prepaying, the two questions or problems are what if claims that come in their door are actually less than what they expected? Are you going to get a refund? Probably not. If you're totally experience rated, that may be reflected in your renewal, but more often than not, we're seeing, premiums go up, not go down. And what the other problem is, what if claims are more than expected? Well, I just explained that depending on the size of those individual claims, it could be reinsured, but typically, if they're more than expected, you get bumped at renewal, and you can try to fight it, or a lot of times what I see as well, or hear from my clients, is when they were fully insured, is that, gee, their broker would come in and say, well, we've got good news and bad news. Which would you like first? Well, the bad news is, give us that first. The bad news is that you got a 15% rate increase. The good news is we really worked hard on this renewal and we got your rate down to 10. So 10%, still a pretty good bump, but typically you're going to see those types of renewals. A retrospective premium, this is a variation of the traditional fully insured rate, but you, the employer, would typically get a 5 or 10% reduction of what you pay fully insured. Traditional fully insured, so you're going to pay 90 to 95% of what you otherwise would be charged. But if claims exceed a certain loss ratio, they have the right to charge an additional 10 to 15% more than what you would have paid had you been fully insured with those rates. And a loss ratio is very simply claims to premium. So if I said you have a 60% loss ratio, that means they've paid out claims 60% of what you paid in premium. So they identify what that loss ratio is up front, but you get a discount up front, but if the loss ratio gets too high, they can charge you more than what you otherwise would have paid with a traditional fully insured plan. Level funded, this has become very popular with insurance companies and employers. So essentially there's two buckets of money. One is fixed costs, and we'll talk about that, and one is claims. So the business would pay 100% of the total or the fully insured premium, but they keep track of those two buckets. And if there's any money left over in the claims bucket at the end of the year, they will give you a refund of 50% of that surplus. Now, why they give only 50% versus 100%, that's just a program that's the way they administer it. I've seen programs that do refund 100% or 60% of the surplus, but the premium up front is significantly higher. So one way or another, an insurance company is going to try to keep some of these funds. If you want 100% refund of the surplus, you just pay more up front, which is a little bit crazy, but that's kind of the way it works. So let's talk a little bit about partial self-funding. And again, partial self-funding, I'm using those terms synonymously. So partial self-funding or self-funding is an arrangement where an employer assumes the risk of the claims. So instead of paying premiums to an insurance company, the employer pays claims with its own funds. You don't give them to anybody. And then what they do is an employer would hire an insurance company or a third-party administrator to do all the claims administration, the adjudication, and so forth. But because these plans are exempt from state law in every state in the country, they're only subject to federal law, ERISA, which is essentially a discrimination law. So when you don't have to comply with state laws or mandates, you can customize your plan to your heart's content as long as you don't violate federal law. And typically that is that we're not discriminating in favor of the highly compensated. So as a result, your plan can be customized to whatever you want for your business and your employees, not necessarily what the insurance company is limited in offering. But this is why we go back to the two questions. What are the benefits I want to offer? We don't have to deal with that question. We can focus on number two, because we can exactly and precisely duplicate your current plan of benefits. Not to be judgmental, but about those benefits, but we don't have to get into, when we look at different insurance companies that you might have your broker look into at renewal, who's cheaper, who's better, we don't have to get into what are the co-pays, what are the deductibles, how the little differences and nuances between insurance companies. We can exactly and precisely duplicate your current plan of benefits. So let's focus on question number two. In self-funding, we're going to again divide claims into two buckets. But unlike the level funded, your group only pays the fixed cost each month. Only the fixed cost. You're not paying or giving that claim money to the insurance company for them to hold like they do in the traditional or the retrospective or the level funded. The business, your business, an employer only funds claims when and if your members incur them. So cash flow is the significant advantage here. You're not prepaying anything. You're not pre-funding anything. You're the employer to hold on to the funds that would otherwise be given to the insurance company. So what are fixed costs? Well, it's pure and simple. It's the cost of administration and it's stop loss premiums. And we'll get into the stop loss in a moment. But the cost of administration, this can be done by either an insurance company or a third-party administrator. And so the administrator, regardless of whether they're an independent TPA or third-party administrator insurance company, they're issuing the ID cards. They put together and issue all the plan documents, the SBCs, the SPDs. They do all the claims adjudication. So they're actually cutting the checks to the providers, the medical providers. They're issuing the EOBs to members. They provide large case management, customer service, and they provide reporting. And one thing to note about reporting is because these plans fall under ERISA, regardless of your size, because I know many of you, if you're fully insured, have been told you're maybe too small, and the insurance company doesn't provide reporting. But under these plans, because they fall under ERISA, this is your data. So it's all HIPAA compliant, but you get some very significant reporting as to the performance of your plan. It's a big difference in a fully insured plan. And claims administration is usually on a per employee per month basis. I've seen it where if an insurance company is doing the administration on a self-funded plan, they might charge a single family rate for the administration, but more often than not, it's what we refer to as a composite rate. It's just a per employee per month rate. So stop loss protection, this protects the employer from two potential areas of concern or of risk. So we purchase a stop loss, a specific stop loss protection, and this protects the employer against any catastrophic claims per person. So for example, you have somebody who has cancer and they have a $100,000 claim. Depending upon the size of that specific or self-funded deductible, let's just say it's $30,000. The reinsurance company or the stop loss coverage pays for all claims over 30,000. The reinsurer would pay everything beyond 30,000. If that same person has an auto accident, for example, or another illness, because the company has already met the specific deductible for that person in that cancer claim, any other future claims are all covered under the stop loss at 100%. The other risk that a group could have is high frequency. So we purchased what's called an aggregate stop loss protection to protect against high frequency of claims. So if maybe you didn't have any of those big cancer claims, but you had a whole bunch of $20,000 claims, purchase protection there so that some of those don't exceed a certain maximum. These work hand in hand. So the premiums for stop loss under the specific, these are based upon the size of that deductible. Here in Colorado, the minimum deductible, self-insured deductible, is $20,000. So a premium, if you have a $20,000 self-insured deductible versus a $50,000 deductible, obviously the premiums are going to be more for that 20 grand. You know, the type of plan you still have. So you're superimposing, the employees still have their plan that you have, question number one, and they're going to pay their deductibles and copays. But beyond that, beyond expenses that exceed those, that's where the plan will fund those claims. So they're based on that plan design and your age, sex, demographics. And then that aggregate stop loss, which is your overall claims limit, again, is determined by those same factors. So the way it works, and they work hand in hand. So just as an example here, let's say on the specific deductible side, you've got a 30,000 specific. Everything beyond 30,000 per person per year is covered at 100% to an unlimited number. And any amount that the employer funds of that 30,000, whether it's $500 that somebody has during the year, or 5,000 or whatever, that all is applied to that maximum claims limit. So it's very quantifiable, but it's for all causes for the whole year for all claims. So everything above that predetermined claim limit is also covered at 100%. So we're going to protect the plan again in the event of a catastrophic claim per individual, or sum of catastrophic claims per individual. And we're also going to protect the plan in the event that there's high frequency or lots of claims. A question just came up. This specific deductible is on a per belly button basis. It's not just per employee. So each and every member has a $30,000 deductible in this example. So just to again illustrate how these work together, let's just say you had 100 life group, and you had roughly, that would be employee lives. If we talked about belly buttons, it might be 2.5 times that. So 250 belly buttons. Well, 250 belly buttons times 30,000 is a lot of money. That's what, 750,000? No, 7.5 million. Well, that's an unacceptable number. So the aggregate attachment point is significantly lower than that, and I'm going to show you an illustration of how it works. So, but it is a predetermined claims limit. And here's a group as just an example. This is a 135 life group. They have a $40,000 specific. The plan designed for employees is a $500 deductible, your typical 80-20 co-insurance with an out-of-pocket limit. But in this example, again, 135 lives, but the specific premium annually is $270,859. That's for the $40,000 specific deductible. Again, everything over 40,000 is covered at 100% to unlimited. We're also going to purchase that aggregate. Now, these are the premiums. This isn't what the aggregate is, but the premium for that aggregate stop loss coverage is $10,000 a year. The administrative costs are approximately $99,000 a year. So what an employer would pay each and every month is 1/12 of this $380,000. And then they would fund the claims over and above that. So the maximum claims liability based upon that 40,000 specific and this group's age, sex, demographics, and their plan design is $820,000 a year. So again, the claims that the group pays, all claims under 40, remember, just like that prior illustration, only the claims that are funded by the employer underneath this, below the specific deductible, are applied to the aggregate stop loss or the maximum claims limit. You don't pay $820,000. That's just the limit that you would pay. So one would ask, how did they get that number? Well, going back to what I said earlier, they're going to look at your plan design. They're going to look at your age, sex, demographics. They're going to look at that, the size of that specific deductible. And in this case, the underwriter expects the group to have $656,000 of claims. This could be based on their prior year. It could be based on their fully insured premiums, what they had paid out in the past. But they don't want to set that maximum claims limit too low because, again, they're paying 100% of everything over that claims limit, just like they are 100% over 40,000. So what they do is they take the expected claims and multiply it by 125%. They add a 25% fudge factor, if you will, just to kind of give them a little bit more cushion, a little more margin of error, and they set this maximum at 125% of expected claims. So in a loss ratio, if you knew the aggregate was 820, you could say, well, what's the expected? Well, you could divide 820, divide it by 125%, and you'll get 656. Or you can multiply 820 by 80%, and you get the same number. It's the same equation. So if I were to tell my client in this case that you're running at 80% loss ratio, that means that the group's running right at where the underwriter expected them to be. If you're running hot and you're running at 90%, you're running a little over expected. If you're running at 60% loss ratio, you're doing very, very well. So in this case, and this is why self-funding is so easily quantifiable, if the group hit the aggregate, which, by the way, only about 1.5% of all groups hit the aggregate because they've added to that 25% margin in there, the group would pay the $380,000 plus $820,000 for a total of $1.2 million. That's it. If they come in at expected, they still have to pay the $379,950 or $380,000. And if they came in right at expected, then they'd be paying, their cost would be about $1,036,000. So these types of plans are easily quantifiable. And actually, I'm going to show you some comparisons with fully insured in a few minutes. So just kind of give you a comparison here. Let's just talk on the left. You see fully insured, the right self-funded. So all of these plans have premium taxes. These are state premium taxes. And there are some taxes, you can call them fees or taxes, but Obamacare collects as well. But those are all collected and paid by the insurer. They're collected from the employer, paid by the insurer. But because we're buying substantially lower premiums, the premium tax is substantially reduced, and in the cases of some Obamacare fees, they're eliminated. The reserves, remember I talked about the reserves that in a fully insured environment are required by law to be held by the insurer to pay claims after you've terminated. But with a self-funded plan, you aren't giving these monies to an insurance company. The client or the employer is holding these reserves, and they can accrue for them. They're easily, again, determinable. But again, it helps with cash flow. Margins, they're eliminated under self-funding, even though I said there's that 25% fudge factor there. Again, they're eliminated if you come in and expected. They're or less, they mean nothing. But in the event of fluctuation of claims, they're held by the insurer. So again, you're giving money to an insurance company to hold rather than you having those monies held by an employer. So claims on the fully insured, they're paid as part of that monthly premium. I mentioned, your plan of benefits are all subject to the state mandates, and you usually can't get data. And if you do, it's pretty sparse. It's not meaningful. On the flip side, over on self-funded, as I said, claims are only paid when and if they're incurred. And we have protection for stop loss in the event of those either high claims or high frequency of claims. We don't have to worry about state mandates because, again, these plans are only subject to ERISA. You may choose to have your plan look like it is today, and that one that is subject to, but that's your call. We get all that claims data, and again, we have stop loss protection for those claim situations. So some of the advantages and disadvantages of self-funding versus fully insured is cash flow. I've talked about this. It's a pay-as-you-go. It actually lends itself to wellness programs and disease management and some other things, some specialty programs that if you can manage those claims too, you never pay them out or you pay a lot less. So cash flow for pay-as-you-go, you hold the reserves, you keep the float on claims payment. You're not giving it to anybody. The savings, again, we talked about premium tax. You could put those funds to use and earn interest on it that the insurance company would otherwise be taking from you. You don't have to deal with costly state mandates if you don't want. And we can get into that in another webinar. But control, that's probably the operative word, plan control. You can monitor your claims, but you have control over your costs. You have greater access to data. And actually, when it comes to plan design and control, if we were to see some sort of utilization that's off the chart, you could tweak your plan at any time. You don't have to wait till renewal, but you can tweak your plan at any time by amending it. Let's just say that we saw a lot of claims in an emergency room, but they were non-emergency. We could design the plan to actually provide incentives to go to an urgent care facility and not an emergency room. It's kind of a carrot and a stick, but we can tweak those types of benefits to make this thing run like a fine-tuned machine rather than just the way it's written. So, and I will tell you, stability, in the 40 years I've been doing this, it is extremely rare that my clients have gone back to fully insured. Usually if they did, they've gotten too small. But because of the success of these plans and the more popular they are under Obamacare, it's extremely rare to see one go back to a fully insured plan. So the disadvantages are, budgeting. So because you could have monthly claims fluctuation, you could have 1 month really good, no claims. The next month you could have a lot of claims. In that aggregate aggregate stop loss protection, we can actually flatten those with what's called an aggregate accommodation. There's a small premium for it, but what it does is it levels out that annual attachment point into 12 monthly amounts, cumulative monthly amounts. Again, in the webinar that's coming up in August is about stop loss and stop loss captives, which is something that's really becoming popular with these programs. But we'll talk about some of those features. Next month, it's unbundled versus bundled plans. I'll get that in that next slide. But the one after that is stop loss and stop loss captives. Another disadvantage is if you were to terminate and go back to a fully insured plan, again, rare, but it could happen. You're going to pay for two plans at once, so to speak. In other words, if you were to start a fully insured plan July 1st, today is June 30th. If you were to start a plan tomorrow, you're going to pay BUCA, Blue Cross United, Cigna, and Humana, whatever. You're going to pay them starting July 1st. But again, you've got run out. Remember that with the reserves that you're holding, you're going to have claims that were incurred in May or June that aren't going to come in for payment until July or August. So you're going to fund those claims in addition to paying your fully insured premium. You are another, I will call it an advantage rather than disadvantage, but you are now the fiduciary of the plan rather than an insurance company. So there are some responsibilities. I mean, after all, you are using other people's money, your employees, to purchase insurance. And I could get into fiduciary responsibility, but at the end of the day, under a fully insured plan, how can you be a responsible plan fiduciary with other people's money, when you don't know what those PPO discounts are from a fully insured plan? You don't know what those discounts are with various hospitals or doctors. You don't know anything about the hospital and doctor pricing at the beginning. I mean, it's impossible under a fully insured environment to be a responsible plan fiduciary. And in many cases, the insurance company takes on that responsibility. But at the end of the day, you're using other people's money to purchase that insurance. And, another one that I will tell you in all transparency is it takes more involvement by your company, because you're maintaining those banking arrangements. You're going to fund the claims. It's not just write one check every month to BUCA. It is funding those checks every week, even if and when those claims come in the door. Also, you've got privacy compliance issues, governmental compliance, federal compliance, but a lot of that is handled by the administrator. So there's two types of self-funded plans. In our world, we talk about bundled plans. These are self-funded with an insurance company. So the insurance company is providing the administration, they're providing stop loss, it's their network, it's their pharmacy benefit manager. Everything is bundled under their roof. The other type of program is what we consider unbundled, where we use third-party vendors that collectively provide the same functions as an insurance company, and usually at a lower cost. In other words, the administrator, we might use a national third-party administrator, or TPA. We would go out and look for independent stop-loss carriers. We can look at a variety of carriers, and they're plug and play. So 1 year you might be with, I mentioned Sun Life earlier. The next year you might be with Lloyd's. The next year you might be with someone else, but they're a plug and play type of thing. We would go out and find our own pharmacy benefit manager. We can look at independent networks. all of these same functions, but they're with best in class, what we refer to as best in class vendors. There's another question there. So what's on the ID card is the question. If it's not using an insurance company, what's on the ID card? When you have an unbundled plan, the logo of the information for the third-party administrator is on the ID card, as well as the employer logo, name and logo, as well as the pharmacy and the PPO network that you might be using. So rather than Blue Cross being on there, all those other logos and contact information are all on the card, the front and back of the card, the 800 numbers, the copays, everything that you would otherwise see on a bundled plan with an insurance company. So providers can recognize it. So let's look at a couple of examples here. This is a group, a small group, 52 lives, that was fully insured with the Aetna, and they were a January 1. Their 2019 annual premiums for these 52 people, and they had a 2-tier rate, as you can see up here, a single family rate. But their premium in 2019, if I use a static enrollment of 52, comes up to almost $880,000, $879,606. Their renewal January 1 of 2020 came in with that at $947,613. They went partially self-funded, and again, I'm using those terms synonymously. They had exactly the same benefits that they had under the Aetna, $20,000 specific deductible. Their premiums for that $20,000 was $373,000 a year. The aggregate premium was $9,653. Now, we put in a fully insured transplant policy, so this reduces the cost of those premiums by more than $10,000. Because when a stop-loss carrier, in other words, anything over 20 for a transplant, is now fully insured rather than insured by the stop-loss carrier. So they like that. They like not having that risk. So for $10,007, we put that in. The administrative costs were $57,000. So total fixed cost of $450,754 a year. Their maximum claims liability is $333,000 a year. So their worst case scenario, if everything all claims just blew up, their maximum liability is $783,848. Remember, they had a fully insured premium. This is their minimum cost and their maximum cost, $947,613 versus minimum cost $450, maximum cost $783. This is what we would call a layup. They're expected to come in at $717. That's $230,000 less the expected than what they would otherwise have to pay to the Aetna. Oh, there's another question. It's about the aggregate. So this is the maximum claims liability. Again, the group does not pay this. Any claims that the group has under 20,000 are simply applied to that maximum. So if you had one claim of $500,000, the group's only going to pay 20. Ridiculous comment here, but if that was the only claim they had, their cost would be $450,000 plus 20. So all claims, you wouldn't get a note back, but basically if you only had that $20,000 claim, they're going to say, okay, well, your limit's $333, you've just funded $20,000, you've got $313,000 to go before we kick in at 100%, just like we kick in 100% over 20,000. So they work together. But as you can see, with a significant savings over their Aetna plan. Here's another one, another relatively small group. They too Aetna 72 lives, employee lives, $30,000 deductible, exactly the same benefits. And they were paying $837,000 a year based on those 72 employees. So I put this in specific, but this really isn't specific. This is their fully insured premium. It's just the way it was illustrated. So when we break it down, 228,000 for the 30,000 deductible, 7,300 for the 7,344 for the aggregate, which brings up a point, I guess, from that last question. If they thought you were going to hit the 314,000, where they're going to be on the hook for everything over that, do you think they charge you more than $7,300 a year? So when they have that cushion in there, that 25%, they're pretty confident that you're not going to blow through expected claims. And if you do, you're not going to hit this aggregate, because if they have the exposure over 314, this number the premium for that protection would be much higher. We again put a transplant program together for this one. So their minimum cost is $315,000 a year. So they would pay with the static group 1/12 of that every year, fund claims as they go throughout the year. And if they hit the maximum claims liability, the aggregate attachment point, they would hit their maximum cost would be $629,000 versus $837, over $200,000 savings per year. And on a 72 life group, that's a not-for-profit. That's a big chunk of change. And if they come in at expected, it's going to be even more significant savings. So the question goes, well, how big do you have to be? Well, I say, how small can you be? We have plans that are as low as with 35 employees. I've got one that's even less than that. But when you start reaching 50 to 75 lives, you start seeing those gaps the savings, the significant savings that I illustrated in those two case studies. It really becomes large, and it becomes larger the larger your group is. So this self-funding or partial self-funding isn't like it was 20, 30 years ago, where every broker or consultant said that you had to be 500 lives or larger. The market has reacted. The stop loss market has reacted and come down and offering programs, stop loss protection, to accommodate smaller and smaller groups. With the smaller you get, it's imperative that you have both the specific and the aggregate protection. When you're several thousand lives, you become credible, you become predictable. Most groups don't have that aggregate protection, but they might have a $350,000 specific. So again, it's about credibility, it's about predictability, and what risk any given employer takes. So what's needed in order to get a quote here? Well, if you're currently fully insured, it's real simple. Well, if you're self-funded, it's also alternative. It's also simple, but the census, which is age, sex, demographics, so taking single or family to tier 3, tier 4. It's going to be good. The absence of a claims experience. So if you're remote, so that underwriters can extrapolate experience from those premiums. Remember, we talked about the two buckets, how your premiums are divided into two buckets. Whether it's level funded or not, they can make those determinations. And if we have claims experience, I need 2 years of experience, and that would include medical and prescription. If you're currently self-funded and you want to see if maybe you're bundled in a self-funded plan and you want to see an unbundled plan, because generally speaking, the costs are going to be lower. I still need a census. I need a plan document or a summary plan description. I need your current administrative and stop loss contracts, because we don't want to have any risk out there. We need to know, what your administrator is going to do. Remember that run out that I mentioned, that you're holding reserves for. We want to see whether your current administrator, it's best to have them pay the run out or a new one, but I need to examine that contract and the stop loss to make sure we don't have any gaps in coverage. And we also need the same claims experience, medical and prescription drug. So that's it. We've gone just about an hour. I hope you have found this informative. I hope you find this intriguing. And I hope you take it under consideration for your upcoming renewal to try to lower your costs. In this world, this crazy world right now with the virus, the prediction of renewal increases is way out there. I'm reading and seeing predictions that are pretty low, and I'm seeing other ones that are extremely high. One of the things that makes this difficult is that in the last 3 months, a lot of folks have not had their elective surgeries and procedures and testing and the type of treatment that they might have for chronic conditions, because the doctor's offices aren't open and maybe they've just gotten a little lax because of that. But claims are down. But the expectation is that now that people are going to go back and have these done, claims are going to go way up. And in fact, some people are predicting that hospitals in particular are going to raise their charges because to make up for the losses that they've had the last 3 months. So it's kind of the Wild West out there. Nobody knows exactly what these things are going to look like, but I would encourage you to get your guns loaded and have some alternatives in your back pocket if you get a rate increase that is unacceptable or going to be hard to manage. So with that, again, Frank Stichter, you can see the logo or the website down there. I encourage you to go to it, and I would be happy to have a conversation with you. No obligation, of course. And I look forward to talking with you next month. I believe it's July 16th. Yeah, I'll confirm that. You will get an invitation, but we're going to dig into that bundled versus unbundled plan, the pros and cons of each. And after that, in August, we're going to talk about stop loss and really get into that and make sure everybody's comfortable with the protection that those contracts provide. So I'll sign off, and I hope you have a great 4th and a great holiday. Stay well, be safe. We'll talk soon. Thank you.